We are hearing that insurance companies are leaving the state. There is a really big issue in California with insurance. What is it going to look like for consumers? Do they have to pay more or they're not going to get insurance?
Right now, we have a market problem and too many people are going to the FAIR Plan. Nobody should want to be in the FAIR Plan. It's meant to be a temporary market of last resort. They're going to pay not just more, but significantly more.
But the scenario you're explaining, if the FAIR Plan has an event, then everybody will get impacted.
Of unfunded liabilities for fire claims after a big event. And so under the law, any deficiency that the FAIR Plan has and the amount of money it has to pay claims, it just turns around to the admitted insurance companies. Well, that has huge cascading impacts on the entire insurance industry. Because remember, as an insurance company's capital decreases, they're not allowed to have as much business in force, and they have to announce massive non-renewals. And then that's going to be a bunch of people who then have to go to the FAIR Plan, and it's an unvirtuous cycle.
My guest today is Rex Frazier, president of the Personal Insurance Federation of California, and he also is a former deputy insurance commissioner of California. Some Californians are losing their insurance coverage, and key insurance companies are avoiding to write more insurance in California. And prices are going through the roof, as a lot of them have to go to their last resort of insurance, the California FAIR Plan. Rex is here to tell us what's happening behind the scenes, why are we here, and if there is a way out.
California has by far the most complicated rate formula in the United States. We have these extreme problems, and it's because of the rules that we put in place in the early 1990s. We haven't updated. Every other state has updated them. The tough part now is just waiting on the regulations to change, right?
Do you have any recommendations for the consumers?
If you have a company now, stick with that company. Don't do anything because it might be hard to find another company right now.
I'm Siamak Khorrami. Welcome to California Insider. Rex, it's great to have you on. Welcome.
Thank you. Thank you for having me.
We are hearing that insurance companies are leaving the state, and there's more and more of them leaving, and there's a crisis. And I don't like to use the word crisis because it's used a lot in media, but there is a really big issue in California with insurance. Can you tell us what's happening with these companies?
You bet. I would say it's not so much companies leaving. There's only been a few companies that have actually said, we're going to file an application and leave California. It's more restrictions in the availability. Most companies have remained, but they have to manage the risk that they face in their business versus the amount of capital that they have to support that business. And so each company's journey is certainly quite different. But by and large, the vast majority of homes are insured by what's called the voluntary market or the admitted market. So the vast majority of homes still have regular insurance, but there's certainly an alarming growth of folks not being able to get insurance through the regular market and having to go to either the FAIR Plan, which I'm sure we'll talk about, or the non-admitted market, which is just a third source of insurance that I think most people wouldn't be aware of. But if you look at the announcement, let's say, from State Farm, which was a few weeks ago, they announced that they were non-renewing 72,000 policies. So a non-renewal means at the end of the term, they would not renew that insurance. That's quite distinct from cancellation. Cancellation is something that the law really doesn't permit companies to do except under circumstances like they didn't pay their premium or they were involved in insurance fraud. That's a midterm cancellation where in the middle of the contract it's ended. So cancellation is not what's happening. It's non-renewal. It's that at the end of a term, a company doesn't renew that business. And in that spot, there's rules for the notification that the company has to give well in advance so that someone can go out and try to arrange alternative coverage. And so for State Farm, 29,000 policies of that 72,000 policies were of single-family homes. The two-thirds of the amount, they were multi-unit apartments. And so when you look at how many homes State Farm insures, 2 million, 29,000, it's a big number, particularly if you're one of those 29,000, so I don't want to make light of it in any way, but it's still 1% of their customers, right? So they, in trying to figure out how to deal with their very serious capital deterioration, it looks as if, just looking at the filing that they made, that they focused on relatively high net worth homes with big replacement cost estimates that really drive their requirement to go out and get a lot of capital to support that business. Because remember, when you sell insurance, the rules require that you have to have money in reserve to pay for the business that you have on your books. We don't just let people...
So if there is a damage, something happens to the house, then you have to pay for it, right?
Absolutely, and so there are solvency-based regulations that make it clear that companies have to have a certain amount of unreserved capital ready and waiting to support the business that's on their books. And so when your capital goes down, well, the amount of business you're allowed to have on your books necessarily, under solvency rules, go down. And so for a company like State Farm, the largest company in California, over 21% of the marketplace for residential property insurance. At the end of 2016, their surplus, meaning the amount of money that's not committed for anything other than just to support their business, it was a giant number, $4.1 billion. It's staggering to think about that much money. At the end of last year, that was $1.3 billion. So they had 30% of the surplus that they had just 6 years before. And so that...
Where did the money go?
Losses. And what was particularly disturbing is that in the last few years, where they had hemorrhaged this amount of capital, we haven't had big fire seasons. We've had a lot of rain. We've had a lot of water loss claims, leaky roofs, pipes bursting, things like that. And it signals that wildfire was a part of what happened with them, but it was also a bigger issue that comes with what rate level are they allowed to be at by the state, and does that rate provide enough capital so that they can support their business? And you know, I hear plenty of people say, oh, these insurance companies have unlimited money, they're doing fine. But it's indisputable that their capital is 30% of what it was just 6 years before. And they disclosed to the insurance commissioner that they had to make a regulatory filing with the state of Illinois to outline what they're going to do to get things back on track. So I'm all for critics saying their piece, but what's indisputable here is the state's market leader had a significant amount of growth. They had grown from about 17.5% of the market at the end of 2016 to over 21% of the market at the end of last year, and clearly that growth was unprofitable because their surplus is only 30% of what it was at the commencement of that growth. So that's a problem. Now, 6 months or a year ago, I think most people were thankful that State Farm had continued to grow. They were the one company of all the insurance companies that had not non-renewed a single home. So they kept all their customers after the big fires of 2017 and 2018. And they continued to grow, obviously, because their market share went up so much. It's hard in a state as large as California to grow 1% of market share. Now we're talking 3.5% in 6 years. So they continued to grow new business. They continued to hold on to their customers, and I think everyone was thankful of that because they were the solid market as so many other companies had other plans. And we can talk about those other company decisions as well. But there was a consequence because it was unprofitable growth. They reached their limit clearly, and they had to figure out how can they pare back the business they have in force given how much capital they have to support that business. And so they reached the end of the road. And you know, last year they stopped selling new business, and the questions I would get from policymakers or reporters were like, is this the start of a trend? It's like, no, this is the end of a trend. They were the last company, you know, to really stop that new business. Certainly many, many companies have continued to write, but everyone else had taken a number of actions after those 2017 and 2018 devastating fires that triggered payment of 24 years of underwriting profit were gone after those 2 years, right? So there were very large loss events. The companies were able to get some of that money back from the utilities that caused some of those fires, but they never get 100% of that money back. So that was a mitigating factor, but it was still a devastating blow to insurers. And so State Farm held out for a very long time and ultimately couldn't hold out any longer. So as a result, now we're hopeful that other companies that have been holding back or taking precautionary actions over the last several years, I think everyone is depending on them, in this moment to be the source of new growth, because it's hard to see how a company that's trying to stabilize itself, stabilize its capital position like State Farm, are they really going to start new growth in the near term? I don't know their business plan, but it would be surprising to me if after they waited so long to make these moves that they automatically turn around and change direction. I think they're going to be working with the Department of Insurance to get to a right rate level that allows them to start growing capital again instead of losing it. So in the meantime, we have to look to all those other companies, and if those companies can't grow, we're going to have to look to the alternative source of insurance, the FAIR plan. But really it depends on the next steps that the state takes with the rate regulation system, and the insurance commissioner has announced what he calls the sustainable insurance strategy, and it has multiple components to it. And at a hearing this week, the largest publicly traded property casualty insurance company in the country, Allstate, did indicate that if the commissioner does implement his sustainable insurance strategy, that as they said this week, they'll grow in every corner of the state. So that's a positive sign by a major player, and each one of these companies has their different journeys. Allstate was largely not selling new insurance, well, they weren't selling new insurance from 2009 through 2019. In 2009, they had asked for a rate increase, and the insurance commissioner, instead of granting the 6% rate increase that they asked for, he granted them the privilege of reducing their rates by 29%. And those numbers didn't pencil out. And so they didn't write new business in California for 10 years. And they went from 12% of the market to less than 6%. So when they came back into the market in 2019, they weren't necessarily as exposed to those 2017 and 2018 wildfires as a lot of the companies that had bigger market presence here. And so, my supposition is that Allstate is now in a better capital position to possibly grow under the circumstances that they outlined this week that involves significant updating of very outdated California regulations.
Are you concerned with stock market volatility?
The markets closing in on their worst year since the financial crisis.
Two of the major indices had their worst day since 2020.
U.S. financial markets had their worst day since the start of the pandemic.
Do you really trust this economy?
Rumors are growing that the U.S. economy could be headed for a recession.
Inflation soaring to its highest level in nearly 40 years. Prices for gas and groceries are so high, inflation sending already sky-high prices soaring even higher across the board.
What if you could invest in a portfolio with a higher fixed rate of return that's not correlated to the stock market? You can turn your monthly income on or off, compound it, whatever you choose, and there is no loss of principal if you need your money back. And absolutely, there are no fees. Just log on to investverify.com. Folks, I personally invest my own money with Verify. Log on to investverify.com or call 888-VERIFY-24. Now let's go back to the interview. Now, Rex, for some of our audience that might have not been impacted, some people have been impacted and they're telling us that their insurance rate has skyrocketed. They have to go to the FAIR plan. But some people have not been impacted and they wonder, why should they care? Yeah. What are your thoughts on that? When these insurance companies are leaving and the insurance market is becoming different, why should people care?
Well, I thought the State Farm example last year when they stopped writing new business was the first time that I really saw what had previously been a wildfire-only problem, which affects a limited portion of California, then turn into something that affects us all on a statewide basis, including people in non-wildfire areas. Because State Farm's announcement last year, when they were not going to sell new business, this is before their non-renewal announcement just a month ago, but when they announced they were not going to sell new business, what they were saying is there was a bigger issue here than wildfire. They were in a capital management situation that they had to address, and that affects us all. So all of a sudden, someone who lives in a bunch of concrete in a big city, they're affected equally because they can't get a new policy from State Farm. And so while the number of residents in California personally impacted by this insurance issue that we're talking about is relatively small to date, it's only going to start growing. You know, to date it's been easy, I think, for a lot of people to say, well, this is an isolated problem. This only affects those people up in the mountains of Northern California, and it's not my problem. I live in San Francisco, or I live in Los Angeles or San Diego. At least San Diego's got some brushy areas. But it was easy for a lot of people to say, this isn't my problem. And while they may be aware of someone who's experienced problems, they're not personally feeling the anxiety and the emotion associated with that. But that's going to grow, right? Because at this point, with State Farm not selling new business, with the second largest company, Farmers, they've announced a cap of 7,000 new policies a month. After that, and they're 14.5% of the market, so you've got 21%, 14.5%, pretty big chunk of the market in those two top companies, State Farm and Farmers. After that, the market share goes down to about 6%. So you've got a bunch of companies at 4, 5, 6% of the market. And if we're going to find our way out of this soon, it's going to need to be a bunch of companies like that who are willing to grow. Otherwise, there's going to be more and more people who have to go to the FAIR Plan, and we can talk about what the FAIR Plan is, what that represents, but the FAIR Plan right now is growing, we think, between 20 and 25,000 policies a month, and that's simply just an unsustainable, unreasonable growth for the FAIR Plan.
And the FAIR Plan is that last resort, right? Insurance of last resort, and
yes.
It costs 5 to 6 times, 10 times the regular
It certainly costs more, as you would think it should. So the FAIR Plan was formed in 1968 after the Watts riots, and there was really commercial insurance availability in Los Angeles. Merchants and others having a hard time getting insurance. And so the state of California formed the FAIR Plan, and what the FAIR Plan is, it's a condition of doing business in California for all insurance companies. So the FAIR Plan's not a government program. There's no state treasury dollars at risk in it at all. What the FAIR Plan is every company that gets what's called a certificate of authority to write insurance in California, as a condition of getting that permission and becoming an admitted insurer, they must join the FAIR Plan. They must subject themselves to the rules and the plan of operation of the FAIR Plan. And so in statute, the FAIR Plan's called a private, non-voluntary association of insurance companies. It's a mandate, insurance companies.
So you have to participate.
You have to participate in the FAIR Plan.
But it's a private organization.
But it's a private organization. Now, it's regulated by the insurance commissioner. The FAIR Plan has to submit rate filings, just like a regular admitted insurance company have to submit those filings to the Department of Insurance. And so in that respect, they're treated like a normal insurance company. And the FAIR Plan is an entitlement for all. Everyone who needs insurance is guaranteed to get that insurance through the FAIR Plan. So you shouldn't want to go there, and we can talk about the expense associated with it. But if you want to close an escrow, you can always go to the FAIR Plan and get a fire insurance policy that satisfies mortgage lenders. Now, to be fair, I know a lot of agents right now who would express frustration because the FAIR Plan, they're being forced to grow so much. Their systems are strained, their quote times are being delayed, and 5 or 10 years ago, I think they had less than 75 employees. They were a small, seldom thought of organization, and now they're the frontline insurers that's selling 3 times as much as Farmers Insurance is on a monthly basis, right? So they're growing while they're trying to answer all the calls, and I know there's a lot of frustration with them, but I would urge people to at least understand what's being asked of them right now is so much, and it's so different than just what they were asked a few years ago. They're growing, and they're going to stumble, and they're going to make mistakes. But at the same time, they are a guaranteed source of fire insurance. Now, if you think about the way insurance works, any pool that only has high-risk folks are going to generate, on average, a higher loss level than a pool of lower-risk folks.
Which is the FAIR Plan, right? It's a
Yes.
high-risk pool, right?
Only people so in insurance language, it's called adverse selection. You have only people who are desperate or high risk go to the pool. You know, in a health insurance context, it would be like people with pre-existing conditions. And you remember before the Affordable Care Act, there were government catastrophic insurance pools, and California had one, where only people with dread diseases or terrible conditions that was the only place, if they didn't have employer-sponsored health insurance, they could go to the state's insurance pool. But the losses in that insurance pool were so profound, and that was state general fund money on the line to support that pool, that the state of California closed that pool, right? So here in the property insurance context, we have the highest risk folks who cannot find a policy in the admitted market. They go to the FAIR Plan. Of course, on average, they're going to be higher risk. And in order to fund those higher risks that generate higher loss payments, the premium to support that's got to be much higher. So there's no doubt the average price of the FAIR Plan should always be much higher than the average premium for a regular insurance company, because a regular insurance company would have all the full spectrum of risks,
is a lot
high
higher
and low. And
yeah.
so the average risk would be a lot lower in a normal insurance pool. Now the problem for the FAIR Plan is they've had a contentious relationship with the Department of Insurance over the last several years, and the FAIR Plan, they went to the Department of Insurance, and under the department's rate regulation formula, the FAIR Plan thought it could justify a 60% rate increase, which is shocking. They filed for a 30% rate increase instead, just realizing the practical situation, and 2 years later, they were granted a 15% increase, right? So that has a consequence, because what had happened in those 2 years, well, inflation took off. And inflation for property insurance means how much does it cost to rebuild a home or to repair a home? Well, those costs skyrocketed. Labor costs are way up, materials costs are way up. And so replacement cost estimates for insurers, they go way up. Well, you have to fund that growth. And sure, when you have someone buy more units of insurance, they pay more in premium, but if the rate is inadequate, you're just selling more and more insurance that's insufficient to pay the expected losses. And so for the FAIR Plan, their total insured value has skyrocketed, truly skyrocketed. Their policy count has skyrocketed. And we probably at this point have 200,000 homes or more that just shouldn't be in the FAIR Plan, because in the past, insurance companies had insured them. And now you have people where their only option is to go to the FAIR Plan. We shouldn't want them to be there. I sure as heck know they don't want to be there. And the real potential for devastation that none of us should want is that as the FAIR Plan grows and grows, it doesn't have the capital to support that business, but under the law, it doesn't have to. It can sell insurance, have inadequate capital, because if there is a big event, and there are lots of scenarios the FAIR Plan has outlined in legislative testimony, losses in Big Bear Lake or all sorts of different scenarios, they could be $4, $5, $6 billion events. And the FAIR Plan doesn't have that much money, not even close. And so there are scenarios where the FAIR Plan could have $2 or $3 billion of unfunded liabilities for fire claims after a big event. And so under the law, any deficiency that the FAIR Plan has and the amount of money it has to pay claims, it just turns around to the admitted insurance companies and assesses them. So with the FAIR Plan, when there is a large loss that the FAIR Plan cannot pay, and you can see scenarios of $2, $3, $4 billion events where they don't have enough money to pay, the FAIR Plan turns around to the admitted insurance companies and says, please pay us the amount that we don't have on your market share basis. So as we talked about earlier, State Farm, just for ease of math, 20% of the market. Well, if there's a $2 billion shortfall for the FAIR Plan, they say, well, we need $2 billion. Well, State Farm, you're 20% of the business. Write us a check for $400 million.
What if they don't have the money?
Well, the FAIR Plan will just issue instructions to pay, and each company has to pay. And remember, this is after a large event where each insurance company is going to have their own claims on their own book of business that they've actually sold. Because remember, these companies don't receive any money from the FAIR Plan. This is just other business that companies have said we can't take. Now the FAIR Plan collects the premium for that. So when large companies would be paying these massive losses after a big event, they're already going to be struggling with that, and then they can just get an instruction from the FAIR Plan to pay money. And in this example, if the FAIR Plan says to State Farm, you have to pay $400 million, that comes out of their surplus, right? Well, they've already disclosed publicly that their surplus as of a month or two ago was $1.3 billion. So in this example, a third of their surplus just goes to the FAIR Plan. Well, that has huge cascading impacts on the entire insurance industry. Because remember, as an insurance company's capital decreases, they're not allowed to have as much business in force because you have to have capital to support the business.
They have to be able to pay for the claims, right?
And so that's going to trigger an immediate capital strain on companies, and it's going to place them, many of them, in a position where they either cannot pay it, and it could trigger their insolvency, or it takes so much of their surplus that they can't functionally move forward with as much business anymore, and they have to announce massive non-renewals.
Canceling
right?
other non-renewals.
And then that's going to be a bunch of people who then have to go to the FAIR Plan. And it's an unvirtuous cycle of FAIR Plan assessments triggering big non-renewals and capital depletion on the insurance companies, and their customers become former customers who now have to go to the FAIR Plan. They increase the liability of the FAIR Plan, and you see that's not a long-term winning approach. So it's not hyperbole to say that if the FAIR Plan continues to grow, it's going to present a huge existential threat to the viability of the insurance industry in California. And we don't want to be there. It's just simply unacceptable to think that when companies are stating in public hearings that they're willing to grow in California if our antiquated regulations can be updated. Why can't we update those regulations, particularly when we're the only state in the country that does business in this particular way? Every other company has abandoned this outdated approach. And in the technology leader in the United States, in California, we continue to refuse to use updated technology-savvy approaches towards the estimation of future losses in California when every other state has moved there. And so we have to move forward with updating our regulations. And of course, there's lots to debate about how to do that. But at this point, I'm not aware of serious argumentation that our only way forward is to stick with what we've been doing.
What is it going to look like for consumers? Do they have to pay more, or they're not going to get insurance?
Well, certainly if their only option is to go to the FAIR Plan, in all likelihood they're going to pay not just more, but significantly more. Remember, the FAIR Plan is only for high-risk policies, and therefore the rates they have in force are high. Nobody should want to be in the FAIR Plan. It's meant to be a temporary market of last resort. We don't want people there. We should want companies, large companies that have sufficient capital to take them out of the FAIR Plan. But right now, we have a market problem, and too many people are going to the FAIR Plan, upwards of 20,000 to 25,000 per month.
Now, what about the people that are on the concrete? You know, the ones that are in San Francisco or LA area that haven't been really impacted by the fires.
Yeah.
Are they going to get impacted?
I don't yet see that scenario, and that's what makes this problem on one level so very difficult, because the vast majority of Californians are not impacted by this. You can know it's happening, but it doesn't hit you or make you uneasy. We're still only talking about a relatively small percentage of homes that have been non-renewed in California. And for the most part, even if you look at State Farm's recent announcement of their non-renewals, they were centered on relatively affluent communities that have a high home values and a lot of brush and woods around them. So areas around Santa Rosa, let's say, or East Bay wealthy communities, or West Side LA communities. But by and large, folks in concrete areas, they haven't yet been affected unless they have a second home, let's say, that might have been impacted by this.
But the scenario you're explaining, if the FAIR Plan has an event, then everybody will get impacted. Essentially that will
it's difficult to even really try to think that scenario through because it's so disturbing. The frustrating thing about the FAIR Plan is because we don't know when an assessment would happen or how much it could be, it's not sufficiently clear to be outlined in insurance company financial statements. Under GAAP, it's not a contingent liability because it's not sufficiently definable and certain, right? So it's this potential liability that companies have on their books, but it's not something that really folks are focusing on. But I'm glad you're asking these questions because we have to get this information out there, that we cannot allow the FAIR Plan to grow because all that's doing is just, it's a game of poker. We're just hoping.
We are putting the liabilities or the risk somewhere else.
Yes, somewhere else.
That we cannot see.
And so those liabilities are going someplace else, and it's sort of turning into our official public policy of the state of California is to cross our fingers and hope there's not a big fire. And that's not a good approach. We have to have an approach to allow the admitted insurers to come back to the market.
So Rex, why is all this happening?
Well, in California, we have what's called a prior approval rate system. And that means that an insurance company must get permission every time it wants to change its rates, either up or down. And so that's relatively uncommon in the United States, but we've had that system since really the early 1990s, and companies, they've accepted it. It's not ideal, but that's just the rules of doing business in California, and companies have voluntarily chosen to do business in California, so it's not something that they regularly dwell on. However, with a prior approval system, it's not like a gas station that can just change the signs on the street corner anytime they want. It takes a significant period of time. California has by far the most complicated rate formula in the United States, and companies have to make very detailed filings that in the old days where we had to have paper filings, they would be a couple feet high. These are very, very big filings that they make. And so there's a level of complexity where if you put yourself in the position of staff at the Department of Insurance, they're trying to figure out, wow, there's a lot to get through. So there's no doubt it's not as if they're going to have a week or 2 week turnaround. But the law that created the prior approval system, it was a ballot measure in 1988, it also said that any rate filing that's not approved in 60 days shall be deemed approved unless the commissioner orders it to a hearing. So there was an expectation, yes, there'll be price control, but it will not harm the marketplace because we'll have quick turnaround on the rate applications. Well, that's not the way the system unfolded, and now these filings can take 6 months, 9 months, well over a year in many instances. But in the lead up to the big 2017 and 2018 fires, you didn't have big inflationary pressures. And so companies wouldn't regularly go in and ask for increases, or if they would, it might be 2 or 3%. It could be upwards of 6%. But there wasn't this huge pressure to get it done immediately. And so the system just kind of worked. And I think what insurers found out after the 2017 fires and then after the 2018 fires for sure is that their rate levels were very low. California has been well below the United States raw average premium. You would say, well, that doesn't make any sense because it's more expensive to repair or build a home in California. So why would we be so much lower than a lower income state like Louisiana or something where, you know, the average premium in Louisiana is over $2,000 a year. Here it's about $1,300 a year. And so why would that be? I think insurers after 2017 and 2018 concluded that the pricing was, we were just in a hole and we were trying to dig out. The problem is we didn't have the luxury to do it slowly. And so in the previous 10 years prior to 2017, the average premium increase in California didn't even keep up with inflation, and that was in a very, very low inflation environment. So after those 2 big lost years, companies were in a hole and they had to figure out what did they do. And so they started asking not for the 2 or 3 or 6% increases, but then all of a sudden you started seeing jaw-dropping increases, 15, 20, 30%. But you would see in their filings under the department's formula that the company could have justified 50, 60, 70%, but just didn't.
Because of the losses, right?
Because of the losses. And so companies, they go to the Department of Insurance, but the problem is that everyone went all at once, and these were huge rate increases. And think of the pressure on the Department of Insurance staff at that point. So they're trying to figure out how to balance all of the concerns because there's affordability issues. You know, if prices are going to...
They also have to advocate for consumers.
Absolutely, right? So,
yeah.
so they have twin responsibilities under the law. They have to make sure that rates are not inadequate because there's a solvency concern. And what's insurance? It's a promise. It's a promise to pay at a future date. And so the Department of Insurance has a responsibility to make insurance companies charge enough money so that they can keep their promises. But at the same time, rates shall not be excessive. And so they have to make sure that when they institute the price controls, that they stop what the state law defines as unreasonably high rates. And so they try to make sure, well, they do make sure that companies stay between those 2 poles, right? But what happens when their own formula shows a 50, 60, 70% rate increase, right? Not that many companies would ever want to ask for that much just because they don't, what, they wouldn't think
they would lose the customers.
They would lose the customer and they wouldn't think they would get, they wouldn't get the rate increase request approved. So why even cause the public controversy from asking for so much? Because private lawyer groups can intervene into the system and they can be a third party challenging these things, right? And so, you know, insurance companies have to pay for their legal costs and everything as well. So it makes it more complicated. So it's just a tough time right now where the Department of Insurance has an historically high level of filings by companies. They're all very high stakes filings. And this is just in homeowners insurance. And then meanwhile, there's auto insurance, and the cost of repairing a car or replacing a car, that's skyrocketed, right? And so companies are in the Department of Insurance asking for auto insurance rate increases as well. And there was a 2-year time period from the institution of the lockdown orders, the state lockdown orders, to 2 years later, the insurance commissioner wasn't approving any auto insurance rate increases, right? And then you have commercial insurance filings. Well, and so do those just get shoved to the side? And there's plenty of examples of 9-month, 12-month, 2-year-old filings, right? Just because there's too much work at the Department of Insurance right now on high-stakes filings, and they're in a bit of a retirement bubble because after the law changed in 1988, they staffed up in the early 1990s to implement this new price control law. Well, a lot of those folks are aging out now, right? So you're losing a lot of people at the Department of Insurance. They had an office move from a very beautiful office with a bay view in San Francisco they moved over to Oakland, and a bunch of people who used to take the ferry from Marin County, they're not going to go to Oakland, right? So they're just losing a lot of people, and I know this will surprise you, but working for the state of California as an insurance regulator is not a popular thing for young people, right? They would rather be influencers or whatever it is they do. And instead, there's a recruiting issue to get people to come work for the state and to be a rate analyst at the state of California, right? So it's a bunch of things conspiring where we have all this work for a dwindling group of people, and the people who are coming in, they need training, right? So it's just, and it tends to be a fairly contentious process when you have the outside lawyer groups come in, because they don't get paid unless there's a fight and it drags on. So it's a bunch of different things that have placed companies in a position where it's difficult for them to quickly get to the rate level that they need to operate in California. And so as that has gone on, and companies have continued to hemorrhage capital, it's a real problem, because now we're to the point where companies still need to go to higher rate levels, but the way the Department of Insurance's rate formula works, companies aren't permitted under the current rules to go higher. How can you have a situation like State Farm where their surplus is dwindling so much, but yet can they even justify under the current rules a higher rate level? That doesn't make any sense. So, for a company like them, are they going to have to make a rate filing asking for special exemption from the rules, which the rules, do have a solvency-based carve-out, where if the formula doesn't permit you to charge a higher amount, you can say, well, if I don't, there could be a solvency threat, so please let me charge more, right? We shouldn't be in that situation where you have to go to an extraordinary remedy such as that. We ought to have a rate-making system that matches the price companies are allowed to charge to the risk that they're going to undertake. And I wouldn't feel so strongly about it unless, without knowing that every other state does it differently than California. And so we have these extreme problems, and it's because of the rules that we put in place in the early 1990s. We haven't updated. Every other state has updated them. And they're rules that for earthquake insurers we already have in place in California. But we still have an old rule for property insurers, for fire insurers, that prevents them from being able to price to risk. Whereas for earthquake insurers, including the state of California itself, that the California Earthquake Authority, which is a state entity, they have to make a rate filing with the Department of Insurance. They use modern rules that the state itself is now not letting property insurers use. And all we're asking is to let companies use the same rules for wildfire or for fire insurance that the state uses for earthquake insurance, nothing more.
Why are so many people leaving California? It wasn't long ago, people from everywhere wanted to move to the Golden State to enjoy a better life. Sadly, the standard of living has been dropping in the past decade. Are you like me and wonder why this is happening? I'm Siamak Khorrami, host of California Insider. In our film, Leaving California, The Untold Story, I take you on an intimate journey of love, loss, tragedy, and hope as residents face the prospect of leaving their beloved state. Everyday people like you tell their stories about why they have to move out of the state even though they don't want to. Experts and policymakers also give insights about what's happening behind the scenes. Together, we get to the root cause of this exodus. Go to leavingcalifornia.com to view the first 15 minutes of the film for free. By watching Leaving California, you can be part of the solution. Again, go to leavingcalifornia.com. Rex, you have tremendous amount of experience in this space, and you worked for the insurance commissioner back in the day. Having this experience and what you see, is this concerning you?
Well, on the bright side, I would say there's a way out. It's within our control. I would say in Sacramento, among policymakers, there's few arguments about why we're in this situation. There's few arguments about how to get out of the situation. And I think the sort of general consensus among policymakers is that Commissioner Lara has outlined a coherent, realistic strategy for leading us out. The tough part now is just waiting on the regulations to change, right? So, and that may sound like it's easy, but as someone who's been involved with the issuance of regulations, they're incredibly complicated legal rules that everyone wants to fight about. And so we certainly would wish if the Department of Insurance, with a stroke of a pen, could update the regulations just to simply match what earthquake insurers do now. At least that would give us the best possible chances for insurance companies to start writing new business again. And frankly, this week in a workshop hearing, Allstate said just that. If the regulations for fire insurance were matched to the regulations that are available for earthquake insurance, they would start writing in every corner of the state of California. So that's a heartening message that you have this giant company willing to go on the record and say that. However, that's not the system that we're probably, or the process we're probably going to have. The Department of Insurance, they've had various workshops and regulatory proceedings, and they're proceeding with their process for issuing new regulations on a variety of the elements of the Commissioner's Sustainable Insurance Strategy. Everyone, is putting pressure on them to move faster, and I think they're trying to figure out how can they put together regulations that are workable, but you have to assume somebody's going to sue them, somebody's going to challenge their regulations because they're not going to like it, and they want to make sure that they're bulletproof as well. So I understand the situation that they're in. I certainly would encourage them to go as fast as they can. And, if there are people that want to stop these improvements with litigation, well, so be it. We can't control that. But what we can control is updating the regs in a very clear way that allow companies to simply say, let us use modern rating tools the way that every other state does and earthquake insurers in California do. So it's not deregulation. It's just simply a different form of regulation that's updated and already in use everywhere else. Why would we hold on to these regulations from the early 90s?
Now, Rex, do you have any recommendations for the consumers?
In terms of finding insurance now?
Yes.
Well, certainly watch your bills and do not miss a payment, right? Stick with if you have a company now, stick with that company. Don't do anything that could result in the loss of that policy for non-payment, right? So just be careful. I know so many people, they get these letters in the mail from an insurance company and it's just some privacy notice or something, but everyone thinks, oh my gosh, I'm getting non-renewed. And it's a high anxiety when you see that insurance company logo on that envelope that comes to you in the mail. So the first thing is just make sure you pay your bills and don't lose your insurance because of that, because it might be hard to find another company right now. But that said, there's still lots of insurance companies that are selling new business in California, so it's not the end of the world if you lose it. The harder part are in the higher risk areas. If you're in a big concrete area, you have a lot better chance. But if there are certain counties now that I'm pretty sure for new business, it's just the FAIR Plan. And we have to reverse that trend. And so it's going to be, if it already isn't, it's going to be a problem that real estate brokers feel, mortgage brokers feel, mortgage bankers, surety, title, escrow, home builders. Because homeowners insurance is this thing that just sits in the background and everybody takes it for granted, but it's what allows transactions to occur. It's what allows real estate transactions to occur.
For mortgages, right?
For mortgages, absolutely. And so when there is a problem, we all start to realize, oh my gosh, as much as people hate to pay their insurance premium, it really does allow things that make our lives better, that lead to wealth creation or intergenerational wealth through property. So I certainly would be worried if this continues to the point where real estate transactions on a pretty broad basis are being impacted, because we've seen that once before after the 1994 Northridge earthquake. And it's a different situation that caused the market meltdown back then. But in 1995, the homeowners insurance market started to slow down because there's a state law that says if you sell a homeowners insurance policy, you have to offer an earthquake insurance policy. Well, companies were so bewildered by the loss event in Northridge that they decided they would rather not sell homeowners insurance in seismic areas if they have to risk selling an earthquake insurance policy. And so because those policies were linked. And so as a result, companies started to slow down their business in 1995. It wasn't until early 1996 that mortgage or transactions were being impacted, and that's where you saw Sacramento totally changed, because once you had all these forces in the economy, mortgage folks and real estate folks and builders, et cetera, all saying, hey, this is a real problem now, everybody's feeling it. This isn't just in a few seismic areas. This is a big problem. The escrows are starting to fall through. That's when the legislature in 1996 created the California Earthquake Authority, which has been a stable earthquake market since then. It doesn't feel like we're to that point yet, but I'm certainly having more and more conversations with banks and mortgage banks and realtors and builders, and we're starting to see them get galvanized to say, hey, legislature, this isn't just sort of a small mountain community phenomenon anymore. We're really starting to feel
Because we saw some
this.
fire stations weren't able to get fire insurance.
That was such a terrible story.
So you have served in the Department of Insurance in the 90s in California, and you have a good overview of what's going on within the insurance industry and all the regulations. Do you think we have the will or the know-how on dealing with this now? Do you feel confident we can do it?
Yes, I do. I mean, the important thing is we're not arguing in general on how we got here, and we're not arguing on what the solutions are. At this point, we're just focused on how to get the right words on the page in a regulation that changes the law so that companies can go ahead and price to risk. And that's a good place to be in. And so I think certainly the longer the Department of Insurance takes in doing these regulatory updates, the more pressure they're probably going to feel from legislators, because those legislators themselves are having the pressure be amped up on them. And so we're ready to sit down day in, day out with the Department of Insurance, legislators, consumer groups, whoever is willing to work on this so we can get these changes. We'll work every day, all day in order to get these done. But we do have to respect there are state processes, and there's a process for issuing these regulations, and we all want things instantaneously, but I think when you're in that seat at the Department of Insurance and you're charged with issuing these regulations and everybody's yelling at you and they're giving you conflicting demands, that path forward's not always as clear to those people who have the responsibility to write those rules. So I'm not making excuses for them, but having been there, I do understand the pressure they're under. We wish they would just take the rules for earthquake insurers and say they, at least on a temporary basis, let property insurance companies use those existing rules for earthquake insurers and just move forward. They could even say, make filings under those rules for the next year or two, and we'll go ahead and finish the formal rules. And once those are done, you'll have to make sure you comply with those. There has to be an emergency way where we can speed this up and let companies make filings that will allow them to grow and start to slow down the growth of the FAIR Plan and then finally reverse the growth of the FAIR Plan, because there's a lot of customers in the FAIR Plan who shouldn't be there. I can say that confidently because 2 or 3 years ago they weren't there, right? There were insurance companies serving them. So there's a lot of good customers that companies I know want to compete for and take out of the FAIR Plan. But it has to be on reasonable terms, on rates that will allow the companies to pay their losses in the future. In the big picture, we can get out of this. There is a path forward. Time is not our friend right now, because the FAIR Plan, if it's growing 20 or 25,000 policies a month, that is just a shocking threat. So the sooner we can act, the better, and we're ready to do our part.
Rex, do you have any other thoughts for our audience?
I would just ask people to think about, what does insurance represent? What insurance is our way of banding together and making sure that we all do our part to fund a system that's going to help people in need. And of course, nobody wants to pay higher premiums, no doubt about that. But I assure people we have a very robust set of price controls in California, and it's not as if companies can just charge whatever they want. But we're at an imbalance here, and right now the prices do not allow companies to operate in the highest risk areas. And so that's going to have to change, and that's going to mean that we all pay more. There's no doubt about that. And I include myself in that, of course. That's the nature of insurance. It's a way to pool our resources and make sure that we're there in really what can be the worst moments of people's lives. And there is a way out of this, and hopefully people understand that the last thing they should want is an insurance company who sold them a promise and then they don't have enough money to pay in that desperate hour. We shouldn't want that either. So there has to be a way where we can get to rate levels that permit companies to ultimately successfully do business and not run onto the rocks, but that's in the short term. In the long term, we have to get a better handle on what communities are going to do when it comes to the presence of fuels around their homes, whether that's grasses or chaparral or whether it's the woods. I think much harder discussions are going to follow this short-term focus on getting the rates and premiums correct. The longer term is a community concern, which is what happens when we have to talk about reducing the fuel that surrounds communities. People move to beautiful places for a reason. They're beautiful. There's lots of vegetation. But do we really think in a world where we think it's going to be hotter and drier and there's going to be more fire behavior, if we don't start coming to a consensus about what it's going to take, how much fuel do we have to remove around homes, in the long term, we're not going to be able to price our way out of it. We can't just keep increasing rates. We have to figure out what community values are we going to have when it comes to touching vegetation. And there's lots of communities that are going to struggle with that because there's lots of folks who do not want brush or trees taken out of their communities. And how are we going to ensure them in a hotter, drier future? It can't just be from higher rates. And I think that's a much more difficult question probably for another show.
Rex Frazier, insurance industry advocate and former deputy commissioner, insurance commissioner for California. It was great to have you on California Insider.
My pleasure. Thanks for having me.
We have an exciting news for you. At California Insider, we created a new product. It's called California Insider Opinion. This is where our insiders and experts across the state are actually telling you what's going on behind the headlines. When there's a breaking news, a big issue, important issue happening in California, they're going to come on the screen and tell you what's happening behind the scenes. And these are like 7 to 10 minutes of opinion formats where the guests are talking to the camera directly, telling you what's happening.
You're paying a tax increase of tens of thousands of dollars every year as a condition of keeping what you already own.
Make sure to look at the description below, because you want to sign up on our newsletter, because a lot of these opinions might be very sensitive that some people in the social media platforms may not like. So we're putting them in the newsletter on our website so you can have them. These opinions will actually help you understand the political and policy landscape of California. We highly recommend you follow it.